Hey traders, welcome back to the channel. Today, we're diving deep into a strategy that many professional traders swear by, and for good reason. It's called the EMA Pullback strategy, and it's one of the most reliable trend-based methods you can use in Forex trading. If you've ever felt like you're always chasing the market, entering too late, or getting caught in reversals, this strategy could be the game changer you've been looking for. The core idea is beautifully simple. We trade with the trend, not against it, and we enter on temporary discounts or pullbacks. This combination of following the dominant market direction while getting in at a better price is what makes it so powerful. So, grab a coffee, get your charts ready, and let's break down how you can master this technique step by step. First, let's understand the two key components, the trend and the EMA. EMA stands for exponential moving average. Unlike a simple moving average, the EMA gives more weight to recent price data, making it more responsive to new information. This is crucial for identifying the current active trend. For this strategy, we'll primarily use two EMAs, the 21-period EM and the 55-period EMA. Think of these as our trend-confirming guides. When the faster 21 EMA is above the slower 55 EMA, and both are pointing upwards, we have a confirmed uptrend. We're only looking for buy opportunities. Conversely, when the 21 EMA is below the 55 EMA and both are pointing downwards, we have a confirmed downtrend. In this scenario, we're only looking for sell opportunities. The space between these two EMAs is often called the dynamic zone of support or resistance. This is where the magic happens. So how do we identify a pullback? A pullback is a temporary countertrend move. In a strong uptrend, the price doesn't just go straight up. It moves in waves, it pushes up, then pulls back slightly to gather more buying momentum before the next leg up. Our goal is to enter during that pullback. We're looking for the price to retrace back towards our EMA dynamic zone, the area between the 21 and 55 EMAs. When the price touches or enters this zone during a confirmed uptrend, it signals a potential high-probability buying opportunity. We are essentially buying the dip within a larger uptrend. The same logic applies to a downtrend, but in reverse. We wait for the price to rally back up into the EMA dynamic zone, which now acts as resistance, and we look for a chance to sell the rally. This prevents us from chasing price when it has already overextended and reduces the risk of buying at the top or selling at the bottom. Now, just because the price pulls back to the EMAs doesn't mean we automatically jump into a trade. That would be too simple and reckless. We need a trigger, a confirmation that the pullback is ending and the main trend is likely to resume. This is where candlestick patterns become our best friends. When the price pulls back to the EMA zone in an uptrend, we want to see a bullish candlestick pattern form. This could be a hammer, a bullish engulfing pattern, or even a morning star. These patterns tell us that buyers are stepping back in and overpowering the sellers, signaling that the pullback is likely over. For a downtrend, we'd look for bearish confirmation candles in the EMA zone, like a shooting star, a bearish engulfing pattern, or an evening star. This confirmation is absolutely critical. It's our final green light to enter the trade, adding a layer of confluence and increasing our odds of success. Let's talk about entry, stop loss, and take profit, the three pillars of risk management. Once you have your confirmed trend and your candlestick entry signal in the EMA zone, it's time to execute. For a buy trade, you can enter right after the confirmation candle closes. Your stop loss should be placed in a logical, protected location. A great spot is just below the low of the confirmation candle, or, for a more conservative approach, below the most recent swing low. This ensures that if the market unexpectedly turns against you, your loss is small and defined. For a sell trade, you place your stop loss just above the high of the bearish confirmation candle or the recent swing high. Let's walk through a complete example. Imagine we're looking at the EUR/USD 4-hour chart. We notice the 21 EMA has crossed above the 55 EMA and both are smoothly angling upwards. This confirms a healthy uptrend. We are now patiently waiting for a pullback. The price rallies for a while, then starts to retrace. It comes down and touches the area between our 21 and 55 EMAs. We don't do anything yet. We wait. Then, a beautiful bullish hammer candle forms right on the 21 EMA. This is our entry trigger. The hammer shows that sellers tried to push the price down, but buyers came in strong and pushed it right back up. We enter a buy order at the close of that hammer candle. We place our stop loss just a few pips below the low of the hammer. We look at the recent high and see there's plenty of room to run. We set our take profit for a 1-to-2 risk to reward ratio. The price then continues its upward trend, hitting our take profit for a successful trade. That's the EMA pullback strategy in action: simple, logical, and effective. Of course, no strategy is foolproof. There will be times when a pullback turns into a full-blown reversal. That's why stop losses are non-negotiable. One common pitfall is trading in a sideways or ranging market. This strategy is a trend-following strategy, so it will perform poorly when there is no clear trend. If you see the EMAs are flat and crisscrossing each other frequently, it's best to stay on the sidelines and wait for a clear trend to establish itself. Another tip is to be mindful of higher timeframe trends. If you're trading on the 1-hour chart, take a quick look at the 4-hour or daily chart. If your 1-hour uptrend is just a pullback within a larger daily downtrend, your trade has a lower probability of success. Trading in alignment with multiple timeframes gives your trades a much stronger tailwind. So how can you start practicing this? I highly recommend backtesting. Go back in time on your charts and manually scroll forward, candle by candle. Identify the trends using the 21 and 55 EMAs. Spot the pullbacks to the dynamic zone. Look for the candlestick confirmation signals. Mark your entry, stop loss, and take profit. Keep a journal of these trades and see how they would have performed. This process will train your eyes to recognize high probability setups in real time. After you've done extensive backtesting and feel confident, move to a demo account. Practice executing trades in a live market environment but without risking real money. This builds the muscle memory and discipline needed to follow your rules without hesitation. Only after you've achieved consistent profitability on a demo account should you consider trading with a small, real account. Remember, trading is a marathon, not a sprint. The goal is long-term consistency. To summarize, the EMA pullback strategy is a powerful way to trade with the market's momentum. You start by identifying a clear uptrend or downtrend using the 21 and 55 EMAs. Then, you patiently wait for price to pull back into the dynamic zone between these EMAs. You don't enter blindly. You wait for a confirmation candlestick pattern to signal that the trend is ready to resume. You manage your risk meticulously with a well-placed stop loss and aim for a positive risk-to-reward ratio. Avoid choppy, sideways markets and always be aware of the higher timeframe context. It's a disciplined, rules-based approach that can remove a lot of the guesswork and emotion from your trading. It encourages patience and rewards you for entering at optimal prices rather than chasing momentum. I hope this detailed breakdown has been incredibly helpful for you. This is a strategy that has stood the test of time and can form a solid foundation for your trading plan. If you found value in this video, please give it a thumbs up and consider subscribing so you don't miss our future content. Let me know in the comments if you have any questions or if you already use a similar strategy. I'd love to hear from you. Thanks for watching, and happy trading!